We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome into Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Aaron Ray is here with us as well today, and Aaron's happy that he doesn't have to do the show by himself like he did the last time he was on this program. You can find out more about Brian, Aaron, and the team just by going to the website deckerretirementplanning.com, deckerretirementplanning.com. And as I always say when we start this program, there are a lot of things you can download off that website. Under the heading of Safer Retirement Education, there's like 12 different things you can download, including Brian's book on retirement, The Decker Approach. There's the 3 Principles of Retirement book that's there. Checklist Challenge Sample Income Plan. That's 4 of the 12 things you could download. There's no cost to you. It's really just there for your information. So again, that's deckerretirementplanning.com if you want to find out more about Brian and the team. Then if you want to find out more, some of the questions you may have about retirement, great thing to do is just get Brian's book on retirement, The Decker Approach. But there's a lot of things you can download right there under the heading of Safer Retirement Education. Always want to start there where it gives you a chance to kind of look into some of the things you have concerns about maybe or questions about. And Brian and the team are here to help you answer those questions by allowing you to download any of those 12 or all 12 of those things that you would like right there on the website, deckerretirementplanning.com. And of course, you have questions, anything that Brian and Aaron talk about today, 833-707-3030. No cost for this chat. There's no pressure, no obligation. The team at Decker Retirement is here to help if they can. They don't know if they can help you, though, until you reach out. 833-707-3030. All right, Brian, what are you, Aaron, going to get into today?
Today, I thought we'd talk about the possibility of recession and the effect it'll have on retirees and their investments and their income and everything else. So, Aaron, let's dive in. Let me take a few minutes and kind of set the table of why we think there's going to be a recession. We don't have a crystal ball, but there's enough information that is out there that points us to believing that a recession is imminent. By the way, the definition of recession, Aaron, what's the most accepted definition that people use for a recession?
It is having 2 quarters of decreasing GDP growth.
Right. Now, the White House wanted to change that when that happened last year, but back-to-back GDP, negative GDP numbers are by definition of recession. So that's what we're talking about is a possibility. Now, Bank of America, JP Morgan Chase, and others are weighing in saying that they expect, yes, there'll be a recession, but it'll only be negative 1 or 2%. It'll be a mild recession. We don't know about that. But we do think that negative GDP growth back-to-back's coming up. So here's why we believe that. Here's the data. The Conference Board it's an index of leading economic indicators, has gone negative. Whenever that happens, that's red flag number 1. The components that make up the leading economic index itself takes into consideration average work week, ISM new orders, consumer expectations, interest rate spreads. Right now we have the 2-year Treasury is higher than the 3 and the 5, so that's an inverted yield curve. By the way, speak to that, Aaron. You've seen a lot of information about an inverted yield curve. Tell us why an inverted yield curve has been a great predictor of recessions.
Yeah, so just to set some context around that, inverted yield curve essentially means that the shorter dated investment options, specifically looking at treasuries, are paying a higher rate than longer dated. So a lot of times people will look at a comparison between the 2-year and the 10-year treasury yield options. As of right now, the 2-year yield is at about just under 4.2%. and 10-year yield is at about 3.57. So in the past, when this has happened, when these shorter dated treasuries are paying a higher rate than the longer dated ones, it typically signals an upcoming recession. So right now, the market is pricing in that the Fed is going to start cutting interest rates at some point in time, depending upon who you ask. That could be later this year or in 2024. And essentially, that is part of the reason why the yield curve is inverted. But historically, it's been a pretty good predictor of when we have an upcoming recession.
And the yield curve inverts because there's a lack of confidence. People want to keep their money more short term. And so the yields short term are higher. And so anyhow, we'll keep going down the list of things. So interest rate spreads are negative. Consumer good orders are slightly negative. Leading credit indexes are part of the leading economic indicators. Stock prices, jobless claims, building permits, all of those things are part of the leading economic indicators. And the index has never declined this much in 6 months without a recession. Let that sink in. Other things, it looks likely as far as timing to be the second half of this year, starting in July through December. As far as timing goes, the reason is because the chart of the leading economic indicator overlapping GDP, the leading economic indicator index has always led GDP, and the LEI, the leading economic indicator index, is now negative. GDP is still slightly positive. What does the index tell us about commercial real estate, building activity? Well, whenever the leading economic index goes negative, it pulls with it the commercial building activity. It has an effect on transportation, or actually one of the indicators is U.S. truck tonnage. There's so much data here. Let's just cap the data part here and just talk about how it affects retirees. When there's an expectation in the stock market that a recession is coming up, usually the lead time is 6 to 9 months. So last year, S&P was down for calendar year 2022 by 19%. NASDAQ was down 33%. And we had a recession last year, first couple of quarters. Now, in anticipation of the next recession, you can expect a slowdown in corporate earnings that will have an effect on the stock market prices. There's 3 reasons that stock prices go up. One is corporate earnings. Corporate earnings are expected to go down in the next 6 to 9 months. The second reason stock prices go up is lower interest rates. Well, the Fed's made it public that they're going to be raising rates at least one more time. So the interest rate expectation is still flat to slightly higher. And the third is an accommodative Fed. Not so accommodative when they're talking about raising rates and keeping them high. So what used to be for 40 years, Aaron, tailwinds, now they're headwinds. There's been an accommodative Fed since 1980. Higher corporate earnings have been expected. Now they're not. And the Fed is not being accommodative, and interest rates are starting to trend higher and go higher. So the effect on stock prices, if we have lower stock prices, what effect does that have on most people that you see come into our office?
Right now, it's going to be a massive effect. There definitely are a range of both risk tolerances and in the way that people actually have their funds invested. But for the most part, I would say the high majority of the people that we meet with have most, if not all, of their retirement savings in some type of equity investment. That could be just the 401k plan that they've had forever, and they pick some, 100% equity or some target date fund. But it's almost always just a basket of stocks and bonds, mutual funds, specific ETFs, with the high majority being in the stock market. And where, like you just walked through, Brian, there are really a lot of great reasons why the market's going to explode and do well over the course of the next 6, 9, 18 months. And there are a lot of things pushing against it. It's kind of a dangerous place to be, right? If you have 70, 80, 90% of your assets that you've saved the last 40 years in those types of investments, And I know we just had a 20% downturn last year, but that doesn't mean that it protects us from another longer, more drawn out recession. So especially if you're already retired or within just a few years of being there, in my opinion, you're kind of gambling at that point in time, right? Because if you want to retire a year or two from now and you have a high majority of your assets in some type of an equity investment, there's a decent chance that you may have a significantly less amount in that account by the time you actually want to finish and stop working, which obviously is not anybody's goal. So we have some things that can help with that, but it is, like I said, it's kind of a gamble at this point in time based off all the stuff that we've been talking about today.
So in your accumulation years, Aaron, you see people coming in their 20s, 30s, and 40s, even to their mid 50s, the accumulation strategies that their advisors from bankers, brokers, they're recommending buy and hold, they're recommending indexing, they're recommending their 401k be heavy market exposure. Markets go down 30, 40, 50%. It's no big deal because you're getting your income from work. In fact, you actually benefit from a market drop of 30, 40, 50% because during that year, 18 months, the markets drop. Every 2 weeks, you're kicking money into your 401k at a lower price. And then when the markets recover over 3 to 5 years, you're better off for that whole time the markets were down. You've recovered with more money invested. You've dollar cost averaged in. Now, what happens when you're retired, you're 65 plus, markets go down 30, 40, 50% on a portfolio that you're pulling money from to live?
Yeah, that's not a great situation to be in. Most of the time when that happens, people have to make some pretty tough decisions, whether that's to just decrease their income because they no longer have the same amount that they planned on or the same starting amount. Other people in worse situations have to make harder decisions. I'm sure you remember back to the 2008 time period where a lot of people had to go back to work, sell their homes, move in with their kids, take drastic income cuts. There were a lot of difficult choices that had to be made at that point in time because they didn't prepare ahead of time. And so in retirement, like you said, Brian, those even just 20, 30% drops, not even some of the major ones, the 40, 50% type, even some of those seemingly smaller drops can have an enormous impact on your retirement. And one of the things that most people don't realize is they just look at the numbers on a chart from either a yearly gain or a yearly loss amount. But a lot of times they don't equate that to a dollar value where people say, oh, I had a 20% loss last year. I just need a 20% gain to get back to break even. That's not exactly the case. If you have a 20% loss, 30% loss, 40% loss, it's 25, 40, 50, 60% to get back to break even. So some of those bigger losses have a much larger impact on recovering or gaining past where you started, just because of the way that the dollar value within those specific accounts work. So at the end of the day, we want to have some protection measures in place to make sure that there aren't these normal drawdowns or even just some type of a black swan event that kind of derails your retirement plan overall.
So Brian and Aaron talking about, okay, the second half of 2023 doesn't look great, doesn't look perfect, that's for sure. Are we headed into a recession? A lot of things are pointing that direction. So the question is, how are you situated? Is that going to be a big deal or not for you? And it really depends on where you are. Are you really close to retirement? Are you in retirement? Are you 15, 20 years out? If you're that far out, it doesn't matter. You just you ride with it and you hope for the best, I suppose. But there's a lot of moving parts here. And the team at Decker Retirement is here to help you create your safer retirement process, the plan, income, investment, taxes, healthcare, legacy planning. And it's about you and your situation, your stage of life, where you are. Do we need to make some tweaks here or there? The team at Decker Retirement is here to help. You'd like some more information. Where are you? What if we do have a recession? How will that affect you? 833-707-3030 is the number. Again, there's no cost for this. The team is here to help. They just don't know if they can help you until you reach out. 833-707-3030. Again, that's 833-707-3030. Might be one of the more important phone calls you make. 833-707-3030. Brian and Aaron just getting started with Safer Retirement Radio. We got a lot to get to. Stay with us. We're back with more right after this.
Have you ever done something and then thought, well, that was a giant waste of money? You might have that same thought in retirement if you don't plan for taxes. Call the team at Decker Retirement Planning to make sure you aren't giving more to Uncle Sam than you have to. 833-707-3030. That's 833-707-3030. Decker Retirement Planning has a question for you. Is your retirement inflation-proofed? Here's what we mean. In retirement, chances are you're on a fixed income with variable expenses. So how do you not run out of money when the cost of just about everything continues to go up? You inflation-proof it. Brian Decker and the team at Decker Retirement Planning can show you strategies to help combat inflation so it doesn't outpace your retirement income. Call Brian Decker today at 833-707-3030 to learn more. Inflation could take a huge chunk out of your retirement savings, but it doesn't have to. With some simple planning, inflation can go from being a major disruption to a minor annoyance. Call Brian and the team at Decker Retirement Planning now to start inflation-proofing your retirement today at 833-707-3030. 833-707-3030. Investing involves risk. Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Aaron Ray of Decker Retirement Planning. Again, you can always find out more on the website, DeckerRetirementPlanning.com, DeckerRetirementPlanning.com. Questions, you can always call the team, 833-707-3030. And the guys are talking today about, hey, the second half of 2023 looks like we're headed into a recession. Now, we've probably already been in a recession. Things are not exactly going exactly the way we want to on the markets and the bond market and all of that. So Brian and Aaron talking about some maybe things you should be thinking about at this point. So Brian, it seems to me that the old buy and hold that we used to do back in the day probably isn't the best case scenario for today's economy.
No, they're different strategies altogether. To build your estate for the golden years of retirement, those are accumulation strategies of buying and holding, riding it out, getting your income from work, being aggressive, every 2 weeks, putting money into your 401k, maxing it out, getting the match. Those are all fantastic ways to build a good retirement. Now, once you're retired, if you draw income, this is key. This is very, very important. If you draw income from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down. So our clients are drawing their income from laddered principal guaranteed accounts. Aaron, how much money, these are short answers, I'm just going to cover, I want to spend more time in other areas, but in last year's market, how much money was lost for our clients in their laddered principal guaranteed accounts?
None. It's a beautiful thing.
In fact, not only did they not lose money, they made money, correct?
Yep, that's right.
Okay, and then the majority of client accounts, laddered principal guaranteed accounts, clients come to us with 60-70% of their portfolio at risk. What's the typical risk exposure for our clients in retirement?
I would say it's probably in the range of like 50 to 25%, somewhere in there.
Yeah, most of mine I see 20-25%. And that money is allowed to grow. This is where I want to spend time on. Our clients last year didn't lose any money in their laddered principal guaranteed accounts. And even in the risk accounts with 20-25% of their money, S&P was down 19%, NASDAQ was down 33%, we were down about 6%. And so for the overall portfolio, we actually made money. There's not many people in the United States that can say that. And so this is something that we're very proud of. And these are it's a proving ground. Last year was a proving ground for the strategies that we use. So let's pick these apart. A lot of people had to go back to work in 2009 because they lost 50% in 2000, 01, and 02, but they were pulling money every year because their advisor told them to use the 4% distribution strategy. So they drew 4, 4, and 4. They're not down just 50%. They're down 50 plus 12, that's 62%. Then the market doubles, but they don't get all that because in 03, 04, 05, 06, 07, they're drawing 4% a year on top of the money that they've already lost. And so their recovery isn't the same as the market. And then when they lose another 50% from November of 07 to March of 09, you saw millions of gray-haired people showing up, fast food, banks. It was a plan B. They had to sell their home. They had to move in with their kids. They had to go to plan B because the accumulation strategies that their bankers and brokers told them to follow did not work in retirement. I want to emphasize all people listening to us, the strategies need to be different. Just like in sports, there's offense and there's defense. Just like in climbing Mount Everest, there's an ascent strategy and there's a descent strategy. Well, in investing, there's accumulation strategies where you build your wealth, and there's distribution strategies that you draw income and you maintain your wealth, and those strategies are entirely different. So what I want to do, Aaron, let's contrast the 4% rule with the distribution strategy.
Yeah, so the creator of the 4% rule, his name was William Bengen. And he actually came out in, I think it was 2009, and retracted that, basically just saying that there are certain markets where it does work well, and there's others where it doesn't. And so a rule that can't be applied in all or most circumstances isn't a great one to hang your hat on when you're relying on that to supply your retirement income. So for us, we're not in the business of gambling with your retirement. We have a very serious goal to keep you retired. I don't think anybody listening is interested in retiring, spending 10 years that way, and then having to go back to work because mistakes were made from a financial standpoint. So we want to make sure that you're aware of the different dangers, of the different risks, and of the ways to solve those problems so that you can have that successful retirement. There's better ways than just guessing and having an alternate income every year, depending upon whether the market did well or did poorly. We want to provide some consistency, safety, protection for your funds so that you can know that from a math-based, numbers-based standpoint, you're going to be okay. You're going to have the income that you need. And we have the vehicles and the investments in place. They're going to make sure that you have those goals met.
Okay, so Aaron, this scenario where the 4% rule works is a bull market, a forever bull market. It works beautifully as long as the market's going up. When the markets go down or in a flat market cycle, the 4% rule not only doesn't work, but it will destroy your retirement. Now, this is very, very important to listeners. There's been 4 times that the S&P's trailing valuation has exceeded 30 times earnings. One was 1929. It started a flat market cycle. It took 17 years to get your money back. 1964 was the second time. It took 18 years to get your money back. November of 1999 was the third time. It took 14 years to get your money back. The fourth time that we hit that valuation was November of 2021. We hit 32 times trailing earnings. If history repeats, and I believe it will, we're looking at a flat market cycle of at least 10 to 15 years where markets look like the GE chart, where for 20 years, markets just have gone up and down, back and forth. There's periods where the markets are doing very well, but then there's periods where it gives it all back. So in that scenario, Aaron, let's go through the strategy. Are you confident that the laddered principal guaranteed accounts can do well in that environment? Let's say we go 10 to 15 years. Let's start with the principal guaranteed accounts. So, Aaron, I want to have you start with an expertise that you really have. You're one of the best in the companies at this. How do you pick your principal guaranteed accounts? Do you just go to broker rate, or how do you pick them?
That's a great question, Brian, because that is really important. Because I'm sure if you just go do any kind of random Google search, you'll be able to find some special magic secret investment that whatever company has. And there's a lot of things to watch out for, a lot of red flags that people don't necessarily understand. And that's where a lot of our value comes in, is we have teams that research a number of different products, principal guaranteed products included, to make sure that not only is it a good investment, but it's also a good company that is issuing that specific investment, because we want to make sure that you're taken care of, and we want to make sure that you can rely on the guarantees that are backing each of those specific investments. So we start with that. We make sure that the institution that is issuing that specific investment is a credit-worthy, stable financial company. Then from there, we narrow down the specific investment options that each of them provide. We run a lot of back testing. We do a lot of math. We have a lot of things integrated to make sure that those are the best performing, highest returning net of fee investments for you. And so we do this in a laddered fashion where we want to make sure to have the liquidity up front that you need, but also take advantage of longer term, higher growth rate investments. And so we mathematically calculate how much dollar-wise is needed in each of those specific accounts. And then we ladder out those buckets to make sure that you can have both the income that you need as well as the higher growth rate on those. So one of the really cool things that I like about this is it's not as though you have to settle for, a 1% rate of interest, especially as interest rates have come up the last year and a half. There's some really great principal guaranteed investments, things that we have in place that help you make 6-8% and still have those guarantees in place. So we want to make sure to balance those all out. That's why we have the math in place to do that. But at the end of the day, they really do help from both protecting the funds, providing the income, and actually getting you a pretty good rate of growth on top of both of those items.
So when you think about all the moving parts in retirement, one of the biggest questions is growth versus safety. And with the Fed raising interest rates to fight inflation, the safer options have become more attractive. You go back to 2010, the only place to put your money to make money was the market. Now there are some safer money options that Brian and the team can walk you through, but it's really about you. What do you need to put you in a better position? The team at Decker Retirement is here to help. All you have to do is pick up the phone and call them. There's no cost to chat with them. 833-707-3030, 833-707-3030. And have you thought about all of these options that you do have? Maybe you're not even aware of them. I wouldn't be. I'm 63. I'm supposed to know it, but I don't. So I love doing this show every week with a team from Decker Retirement because I'm gaining knowledge. They're here to help guide me. That's what I need. I need a Sherpa, that guide to help me up the mountain and down the mountain. 833-707-3030 again is the number. No cost to chat with the team at Decker Retirement. They are here to help if they can. Back with more with Brian and Aaron right after this. This is Safer Retirement Radio.
Excited for retirement? All that daydreaming can be time-consuming enough as it is. So why not get a little help with your retirement planning? Call Brian at 833-707-2020 and see where you stand in retirement.
Welcome back to Safer Retirement Radio with Brian J. Decker and Aaron Ray of Decker Retirement Planning. Again, you can always go to the website to learn more, deckerretirementplanning.com. And on that website, or in that website, there's also, under the heading of Safer Retirement Education, 12 different things you can download, including Brian's book on retirement, The Decker Approach. A lot of information there just for you. There's no cost to go there. You can download any or all of those 12 items right there on the website, deckerretirementplanning.com, under the heading of Safer Retirement Education. Grab what you want. You want to learn more about this or that? Brian's book is a great place to start, The Decker Approach. But again, that's all on the website, deckerretirementplanning.com. And if you have questions, you can always call. I think I'm 63. I prefer not to go to the internet to find things out. I want to actually talk to somebody. You might be like that as well. Call the team at Decker Retirement. Throw out some questions or concerns you have and see if they can help. 833-707-3030, 833-707-3030. And Brian, that's probably one of the biggest differences. You go back to 2010, 11, 12, when interest rates were down to nothing, that our only place to make money was in the Wall Street world. Today, with the Fed raising interest rates to fight inflation, there are way more safer options than ever before.
Correct. Okay, and interest rates, the reason that we have the approach of laddering interest rates is interest rates are going to do one of three things. It'll go up, down, or flat. In fact, there's a little history behind this. Starting, one of our charts that we use, Aaron, is an interest rate chart on the 10-year Treasury that goes back to 1870. And in that chart, it shows that in 1940, the 10-year Treasury rate was 2%. 40 years, interest rates were rising until almost hitting 15% in 1980. 40 years of rising interest rates. Then from 1980 to 2020, 40 years of declining rates, where it bottomed in August of 2020 at 0.47%. Now interest rates are on the rise. Are we going to have 40 years of rising interest rates from 2020 to 2060? Nobody knows. But in a rising interest rate environment, the last thing you want to own, Aaron, is our bond funds. Explain interest rate risk, how that works.
Sure. So interest rates and bond funds have somewhat of an inverse relationship, where as interest rates rise, as they have dramatically over the course of the last year and a half, bond funds lose money. So this came as a big shock to a lot of people last year, especially where there was a lot of concern in the market. People saw the S&P and the NASDAQ and some of those other major indexes having those large declines. So a lot of people, whether on their own or by recommendations, put more money into those bonds and bond funds, because that's typically the rhetoric we hear of that's viewed as the safe or conservative portion of their portfolio. It's kind of where that 70-30 or 60-40 portfolio mentality comes from. Now, what happened in reality was not only did the major indexes have a double-digit decline, but because interest rates rose so dramatically and over such a short period of time, those bond funds that were meant to be the safe portion of the portfolio also took big losses. I've seen a lot of bond funds that last year in 2022 lost more money than the S&P did. So S&P was down about 19%. A lot of those bond funds were down 20, 25, 30%, depending upon their focus. So that came as a big shock to a lot of people, where they thought that they were protected. They thought that bond portion, whether 30, 40, 50%, would be a little more conservative or help offset some of those big declines from market losses in the S&P or the NASDAQ, but instead got somewhat of a slap in the face for that. So we want to help illustrate that there are better ways to be able to move towards that protected, conservative, safe allocation that aren't bond funds that have that simple interest rate risk.
In a rising interest rate environment, the last thing you want to own are bond funds, and it's certainly not safe money, but banks and brokers are continuing to tell their clients to keep their money in safe money investments like bond funds. Not only did the average bond fund lose 20% last year, but another 15% the year before. So 35%. Imagine your safe money, Aaron, losing a third in the last 2 years. The average stock account last year was down over 30%. And so that's quite a hit for someone in retirement. But we don't use bond funds because of interest rate risk and in a rising interest rate environment. Our clients are using laddered principal guaranteed accounts. So in our interest rates, nobody knows where interest rates are going to go. But here is why laddering your principal guaranteed accounts is a smart way to go. So our cash accounts are where we're getting I bonds for 6.8. We're getting 1-year CDs for 5.2. We're getting money markets at 4.5. All the while, so many people that we help on cash management, Aaron, still have their money in their bank or their credit union earning 1% or maybe 2% if it's in a credit union. It's horrible how much money they're leaving on the table. And so just on cash management, where we're helping our clients work their money, their cash portion of their portfolio, linking their accounts so they're keeping maybe, I don't know, a smaller amount to pay bills on with their banks, and the majority of the money that they want liquid, they're earning 4.5%, 5+% on that money. That's just on the cash part of the principal guaranteed accounts.
Yep. And let me jump in here for a second, Brian. It's one of the things that I've had to have a lot more discussions about recently, because it's a little bit of a mindset shift. I mean, if you think about the last 10, 15 years, there haven't been a lot of other places to get either highly liquid and interest-bearing accounts or higher rates of return. And so now that interest rates have gone up to where some of these accounts, the I bonds, the CDs, money markets, some of those other type cash management accounts are actually yielding pretty good returns, people aren't used to seeing that. And so if people aren't researching it or keeping up to date on those things, they may have missed that. So like you said, it's a great way to be able to earn some extra interest, still have your cash liquid, ladder those out to be able to help supply extra interest yield over the next few years. And it's shifted from a few years ago. So it's nice to be able to have those options now.
Okay, and that's just the cash side. Then we have the 3, 5, 7, and 10-year laddered principal guaranteed accounts. Where are we getting the best returns on 3 and 5 years? Just describe the type of investment that we put in there.
Yeah, so there's a few different fixed rate investments, and a lot of those are doing pretty well right now. Like I think most of the ones around a 3-year time period are about 5.5%, and we're getting slightly more than that over a 5-year time period, and that's pretty good. They're fixed rate. You know exactly what you're going to get. It's locked in for that time period, and you can rely on that over the course of those 1, 3, 5-year time periods to be able to help in that laddering effect to make sure that those interest rates are working in your favor instead of against you.
And then for 7 and 10, by the way, if the stock market is flat for 10 to 15 years, like we talked about in the last segment, this part of the money is bringing it home for the retiree, right? They're making, in the cash management accounts, they're making 4.5, 5. In the bucket 2 and 3, the 3 and 5 year fixed rate accounts, those are all over 5%. Those are going to make their money whether the stock market's up or down. So that's fantastic peace of mind for our clients. But then let's get into the 7 and 10 year taxable accounts. What are we plugging in there?
Yeah, so these accounts have done really, really well recently. They have a principal guarantee attached to them. So again, like those other fixed rate options, these do not have the ability for loss, which in this flat or choppy market cycle, which we're expecting to see over the course of the next 5-10 years, these accounts still can make money. Now, unlike the shorter dated 3 and 5 year time period ones, these have a variable rate of return. But most of them have averaged in between 6 and 8%, which is pretty good for still having a principal guarantee attached. So again, like those other products, we have teams that go out and do research to be able to find the highest returning net of fee principal guaranteed accounts. And with these on a longer time horizon of 7 years, 10 years, or a little bit longer, we've been getting some that average in that 6%, 8% range, which is great. And still having that protection in place where even if the market takes a nosedive and we don't have a great return from a market perspective, these can still chug along, help you earn some interest in retirement, all while still pulling income.
Okay, and on those 7 to 10 year principal guaranteed accounts with those great rates, like averaging, since inception, returns of 8.5, talk about the liquidity of everything we've covered so far. The liquidity of cash and a 3 year and a 5 year and a 7 and a 10 year. How does all that work?
Sure. So let's walk through them one by one. So the way that we ladder these accounts out, again, is from a mathematical standpoint. It's not like we just say, hey, let's put 50 grand here, 100 grand here. We want to make sure that everything is optimized as much as possible. And so for most of the plans that we put together, we'll have 5 or 6 different principal guaranteed accounts. And within those, they each have liquidity structures specific to those investment types. So for some of the accounts within our early buckets that are meant for income right away, we want to make sure to have the liquidity needed so that we can pull funds right away, all while earning a higher rate of interest. So those are typically 100% liquid. And then for the accounts that are not needed right away, starting with the bucket 2 and bucket 3, those are usually 3 and 5 year fixed rate investments. And those work very similar to CDs, where you put your money in that specific account. It's locked up for that 3 or 5 year time period. After that, it's 100% liquid, and you take it out as part of the monthly and yearly income that we have established for you. Then for those longer dated buckets, those focused on a 7 or a 10 year plus time frame, those are a little bit different from a liquidity standpoint. We call these limited liquidity accounts. These are those that have most of the time about a 10% per year free withdrawal, where you can invest the money in the account, pull 10% of that account value every year with no penalty. And then after a specific time period, whether that be 5, 7, 10 years, the account is 100% liquid and you can pull the remainder of the funds out. And during those years, during those first 10 years, we are pulling funds from each of those accounts at varying points in time. Again, this is all based off of the math that we have set up, but we want to make sure that we're optimizing both the starting values of each of those accounts and the specific income amounts that you are withdrawing from each of those buckets to make sure that you're maximizing both the protection and the income that you can receive from those. So we make sure that we take care of you on a year-over-year basis. Always make sure that those accounts are in line and the accounts from an interest and an income standpoint line up with the income that you need for those specific expenses.
So at the end of the day, when you think about it, everybody's situation is unique to them. And that's how the team at Decker Retirement Planning looks at this. How can they help you, whether it's the bucket strategy or some other strategy? But it is about you. You probably, hopefully, don't need 100% liquidity in everything you have, right? So the idea is, how do we make this, because the number one fear amongst retirees is still the fear of outliving their money. So you need to have a plan in place. And it's not so much about the return on investment like it was when you're working. It's still important, but it's about the return of income. Income is what you need in retirement. The paychecks are no longer coming in. And the Decker Retirement team is here to help you do just that. Everybody's situation is unique, and that's how they look at it. What do you need? How much do you need? How long do we need it? All these different categories. 833-707-3030 is the number. Again, there's no cost for this. 833-707-3030. Brian and the team are here to help if they can. They just don't know if they can until you reach out. 833-707-3030. Brian and Aaron will continue this discussion in our final segment of today's Safer Retirement Radio. Back with more right after this.
Confused on when to take Social Security? Give Brian J. Decker a call at 833-707-3030. What if you ordered a pizza, but when you opened the box, a couple of pieces were missing? That would be upsetting, right? Now, think about how much you believe you've saved for retirement. Do you still owe taxes on that money? Brian Decker and his team at Decker Retirement Planning understand the importance of tax planning and can help you reduce the impact that Uncle Sam has on your retirement. Give them a call today to start working on your retirement tax plan at 833-707-3030. Now may be a great time to lower your future tax liability. Create a retirement plan today so that you can get as many slices of your retirement pie as possible. Give Brian Decker a call at 833-707-3030 and schedule a visit. That's 833-707-3030. Firm offers insurance services and may not give tax advice. Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Glad you're with us today for Safer Retirement Radio with the team from Decker Retirement, including Brian J. Decker. Brian started this company. He's been in the financial world since 1986. Also joining us is Aaron Ray. You can find out more about Brian and the team, DeckerRetirementPlanning.com, DeckerRetirementPlanning.com. And don't forget, under the heading of Safer Retirement Education, there's 12 different things you could download, including Brian's book on retirement, The Decker Approach. No cost to you. It's all there for your information. And you can always call 833-707-3030. If the things Brian and Aaron have been talking about, you're like, wow, that sounds pretty unique. I'm not doing any of that right now. I would like to learn more. Give them a call, 833-707-3030. All right, Brian, you and Aaron down to your final 11, 12 minutes. You're going to keep into that distribution plan?
Yes. The number one fear of people over 60 in the United States is now and has been running out of money before you die. Our clients don't have this because they see visually from a spreadsheet, we call a distribution plan, how much money they can draw from their portfolio. We add that to the amount of money that they're drawing from Social Security, from pension, from any rental real estate. We total it up minus taxes, and that gives them to see annual and monthly income with a COLA, cost of living adjustment, to age 100. You can't look at a pie chart and see how much money you can draw for the rest of your life. So of course, so predictable. The number one fear of people in retirement is running out of money before they die. And by the way, Aaron, how many people come in and they're using the pie chart, they're guessing how much income they can draw, and after you show them version 1 of their plan, are not happily surprised on the amount of net of tax income they can pull out of their plan each month?
Oh, it's few and far between. That's honestly one of my favorite parts about working here at Decker, is that we get to show people by the numbers exactly what it is that they can have as income. And I would say the high majority of the time, it's a much better number than people expect. The typical scenario for me is they come in, they may or may not have some kind of idea around how much income they can have or how much income they want. They give us all their information. We put together an income distribution plan for them, and they get to see their real numbers. And a lot of the time, it's a really awesome conversation because they say, man, I never thought I'd be able to retire, or I don't think I'd be able to have that much income or retire as soon as I wanted to. And it's a really great document to be able to help them make decisions. Because I have people come all the time that are like, well, I think I want to retire at this age, but I don't know. I'm not sure if I'm confident that I'll be able to have enough money. And then we can walk through and show them by the numbers exactly what their income's at and how that can reflect the rest of their retirement. And it's great conversations to be able to just narrow that down for them and show them, hey, you can have the income that you needed. You can have it sooner than you expected to. And you know exactly where it's coming from, how the protection is built in, how the growth is built in. It answers a lot of questions for the people that we meet with.
That's right. And our second biggest fear of people in retirement are these market hits that roll through the stock market, because they take a hit and their advisor says, and by gosh, I was trained on this. After 1987, I was told to call my retired clients and say, you should probably cut back on how much money you pull from your portfolio, let it recover. Well, how can you enjoy your golden years if now your advisor is telling you, well, you better not spend much, let your portfolio recover? We don't do that at Decker Retirement. Our clients don't need to do that. Like we talked about in 2 segments ago in the radio show, that our clients did not lose money in any of their principal guaranteed accounts. And we look at the typical total portfolio that we put together. They didn't lose money in the total portfolio either last year. There's not many people in the country that can say that. So when the second big concern or fear in retirement are these market hits, the genius of distribution planning is the strategies that we employ for the risk portion of their portfolio, which is 20-25%. So if a client has $1.2 million, 65 years old, in 20 years, they're going to spend through the laddered principal guaranteed portion of their portfolio. So in 20 years, they'll spend that money in 20 years with the income and interest that they make, the money that they earn on that. That allows 20 years for 25% of their portfolio to grow and replace what their starting value is, so they have another 1.2 million ready for the second part of their retirement. Think about that. That's the genius of distribution planning. So in the 20 years that we have to grow the risk portion of the portfolio, do we buy and hold in what we've already talked about is an expected flat market that, like 1929 to 1964, 1999, and now November of 2021, 4 times the market has traded above 30 times trailing earnings. 3 times the markets have traded flat for between 14 and 18 years. We've entered a flat market cycle in the stock market. And so now the strategies that have worked in the last, since 2008, those strategies are not going to do well. Passive investing, buying and holding stocks, mutual funds, or indexes are not, those strategies don't work in a flat market cycle. So what we do on the stock portion of your portfolio, if we're a math-based firm, if we are fiduciaries to our clients, which we are, imagine, Aaron, could you even do it? Could you look at your clients and say, we've got these 5 mutual funds, let's just use these. I know, Mr. and Mrs. Client, there's better funds out there, but let's just use these. Could you even say that?
No, I wouldn't be able to take myself seriously.
So what we do as a firm is we go to the biggest databases in the world. Anyone could do this. We do it. I don't know of any other firm that does this. We go to the Wilshire database, largest database of money managers in the world. We go to the Morningstar database, largest database of mutual funds in the world, and a couple others. And we have 4 requirements for our managers. Number 1, manager has to have gone through a down market. Or to us, if they haven't, they've not been properly proven to know if they can protect capital in a down market. So that's number one. Number two, they have to show actual numbers. Number three, they have to show net of fees. Number four is the most important. They have to have third-party verification on their numbers. So we gather the numbers quarterly, and then we have 4 requirements for these managers. We get rid of managers that are closed to new investors. They're not taking any new clients. We get rid of them. Number two, we get rid of managers that are
what are called hedge funds, because they have the high volatility there. Number three is that we get rid of those that have per account minimums of $2 to $5 million. And then 4, we also get rid of what are called high beta managers, essentially those that do extremely well in the good years and very poorly in the bad years.
Right. And in the strategies, so the managers are just one part. The strategy is second. So what I'm a promoter of, and Aaron, you weigh in on this, I'm a big promoter of, just like in sports, there's an offense and a defense. When the market is trading above its 200-day moving average, it's technically in an uptrend, and we buy the indexes for part of the portfolio. A third of the portfolio in the NASDAQ, a third in the S&P, a third in the small cap index. But when the markets trade below the 200-day moving average, I don't know, in my 38 years of doing this, I don't know of any better way to protect capital than to use the managers that we have that are computer trend following managers. These are managers that when the market trend is higher, you are long the market. You're making money as the markets go up. But when the market trend goes lower, they take you to cash. This is true in how we trade the NASDAQ and how we invest in gold and silver. And then we also have a manager that is a computer manager, but he's pure momentum. Let me give you an example of how this relative strength or momentum manager works. In 2000, 01, and 02, when the S&P was down 50% and the NASDAQ was down 70%, there were several sectors of the market that still were doing very well. Gold and silver did well. Real estate did well. Energy did well. Healthcare, biotech, all those sectors did well, even when the markets were getting creamed. In 08, when people lost another 50%, there were sectors that did well. There were very few. It was gold, silver, US dollar, and treasury bonds. Those were the sectors that did well. So what this manager does for us is look at the sectors that are doing well, even though the markets are in a down market or in an up market. He's looking at pure momentum. And so we use those managers. Those managers have done well. In the last 22 years, they've only lost money one time in a down market, and that was last year. They lost 6% when the S&P was down 19 and the NASDAQ was down 33%. They're able to do very well in up, flat, or down markets. We are fiduciaries, and we use those to protect capital in a down markets.
So if you have questions about any of this, and Brian and Aaron, boy, they covered a lot of ground today, as we always do, on Safer Retirement Radio with Brian G. Decker of Decker Retirement. The number again is 833-707-3030. No time like the present. I think this is one of the more important phone calls you could make, because we're talking about the next 20, 30 plus years of your life. The team at Decker Retirement here to help. 833-707-3030. And if we're going into a recession, are you set up for that? Will you be okay? That's really what you want to know. If we retire, are we going to be okay? That's what we want to know. Brian and the team are here to help. 833-707-3030. 833-707-3030. So thanks to Brian. Thanks to Aaron. Appreciate you being with us for Safer Retirement Radio. Enjoy the rest of the weekend. Have a great week. More Safer Retirement Radio next week. Same bat channel. Have a great week.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement. Decker Retirement Planning has a question for you. Is your retirement inflation-proofed? Here's what we mean. In retirement, chances are you're on a fixed income with variable expenses. So how do you not run out of money when the cost of just about everything continues to go up? You inflation-proof it. Brian Decker and the team at Decker Retirement Planning can show you strategies to help combat inflation so it doesn't outpace your retirement income.
Call Brian Decker today at 833-707-3030
to learn more. Inflation could take a huge chunk out of your retirement savings, but it doesn't have to. With some simple planning, inflation can go from being a major disruption to a minor annoyance. Call Brian and the team at Decker Retirement Planning now to start inflation-proofing your retirement today.
At 833-707-3030. 833-707-3030.
Investing involves risk.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC.